let's talk about Evergrande, and I think it's important to set the stage here. And first and foremost is this is all driven by the government, right? I think that's the most important point. This is not some uncontrolled thing that just happened in the markets and the government's completely caught unaware. No, it's the exact opposite. Property has been kind of the big elephant in the China growth story for years and years. And in fact, it was a year ago, a little bit more than a year ago, in August 2020, when the government laid out the 3 red lines for the property market and for the developers, namely that they were caps on the liability to asset ratio, the net gearing ratio, and the cash to short-term liability ratio. And so over the past year, the entire property sector, of which Evergrande is one of the biggest, all the developers have been trying to get under those red lines. Most of them were over the red lines. In other words, were excessively levered prior to the government saying, hey, guys, here's how we're going to move forward. And as we've seen in the last couple of weeks, with all the other things going on in China, whether antitrust or social inequality or tutoring, when the government says something, clearly this needs to be paid attention to. So this is not it's not a news story. B, the government is driving this process. And C, Evergrande has been aware of this and has been trying to deal with it and get their financial house in order. The problem has been that they have not been successful in getting their house in order. And so they are still under the red lines in 2 of the 3 cases. And so they're essentially an illiquid property company at this point, not insolvent. Importantly, I think that's an important point. And so the issue here is that there's going to be some resolution. I think it's important to note when you're talking about the market action today, to note that China was closed today. So part of the issue is that the things that one wants to trade has not been able to be traded. So you've seen action in lots of other things like Hong Kong, et cetera. But there will be some sort of a government imposed decision. We all know that Evergrande owes a couple of notes coming due this week. How that will be dealt with will remain to be seen. But I think it's already had its effect on the markets. And so I don't think, importantly, the issue for us should be contagion. And here I think it goes back to that point that the government has set the 3 red lines in place. The government knows that Evergrande is in trouble. The government has had the various banks stress test their books to assess the risk of Evergrande. It's important to know that all of Evergrande's debt is already trading at distress level. So this is not something that came out of the blue, right, and was priced at a double-B credit and then just collapsed. No, this is already trading at distress levels. I think you bring up a great point, Roberto. Yeah, this is one of many issues that people are wrestling with, and I think it's important to set the stage. And I did set the stage a little bit with my Friday Musings, right? Yeah. It's titled "Back to the 1990s," and that's more from the strategic point of view, which I know we'll get into in a little bit. But I also talked about the tactical outlook, perhaps maybe more sanguine than today would suggest, for sure. But I talked about a couple of things, and I'll just reference them for the audience today. Again, this is today. This is prior to Monday's trading in the U.S. or anywhere. The AAII Bull Bear Survey in the U.S., which measures individual sentiment, was already at a bearish point. The 6 top tier 1 banks have all called for a correction, again, prior to this weekend. The average, here's a couple of really interesting statistics. The average New York Stock Exchange listed stock, so the New York Stock Exchange Composite, is off 18% from its 52-week high. Again, before today. The average NASDAQ stock, this is amazing to me when I read this. The average NASDAQ constituent stock is off 27% from its 52-week high already before today. JP Morgan makes the point in some of its work today that U.S. cyclical sectors, namely the banks, energy, and materials, are off anywhere from 10 to 30% from their Q1 highs. And yet their forward EPS estimates have increased anywhere from 25 to 50% in that intervening 6 months. So stock prices have gone down, earnings have gone up in the major cyclical sectors in the United States. Furthermore, in Europe, Europe is now trading 1 standard deviation cheap relative to the US on a forward earnings basis, one of the more attractive rates in some time. And you have a situation where you have then today, so that's the stuff, that's the setup for today. Bull bear, already bearish. Bank of America expectations very low, back to spring level, spring 2020 levels in terms of growth in earnings, their big fund manager survey. The average stock off 20%. The cyclical stocks cheaper and generating more earnings than they have in a considerable point of time. Yeah. That's the setup going into today. So then here's today. Today you had on the tick ratio, which is stocks going up versus stocks going down, you had the second worst rating in 31 years. Okay, you had so many stocks falling this morning that it was a second worst tick ratio reading in 30 years. I should also mention, by the way, that AAII bearish survey sentiment was the second sharpest decline from bull to bear in 30 odd years. I think it's 34 years in that case. And that was, again, prior to today's trading. So you had a tick ratio, today's trading, capitulation level. You have the RSI, the short-term RSI in the U.S. hitting 31, the first time it's hit low 30s this year. You have Europe trading back to July levels, back to levels 2 months ago. And you had, as we know, this week is traditionally not a great week for returns, the week post the September option expiry. So all this is kind of in the mindset. And you're now very close to those levels that we hit back in July when we were discounting the delta. So when you put all those things together, I think you can get a sense that there's quite a bit of bearish sentiment now fully expressed between what I suggested was in place prior to the weekend and prior to today's trading. Now coupled with today's trading, I think that's quite a bit of bearish sentiment. The offset to that, which I think is important, is the following. And I made these points in the musings. The first is that the Delta variant is fading. Absolutely no doubt about that in the United States. Even in the worst hit states, case counts are down by roughly a half. Japan, there's some talk today that Japan may end its lockdown later on this month, which would be very, very helpful, particularly for the Asian reopening trade that I've been talking about for the last couple of weeks. I don't see Evergrande doing anything to derail that reopening process in Asia, by the way. You've had better economic data in the U.S. after a couple months of pretty subpar data. Last week, you had the August retail sales better than expected. You had the Philly Fed better than expected with some really good news on the supply chain front, where inventories rose, delivery times fell, open orders fell, those types of things, suggesting that maybe we're at the beginning of fixing some of the inventory reopening on the U.S. side. And then if we get the Asian reopening, which is where the production of the world, right, the factory of the world is located, then maybe we get some better news on the supply chain. You get lousy sentiment, as I referenced with the AAII. You had weak expectations, as I referenced with the Bank of America manager survey. So that was the setup going in here. And my view is that peak global growth already happened in the second quarter, right? Growth rates are decelerating. You had China growth rate peaked in the first quarter, year-over-year growth rates, right? And it's important to note that peak year-over-year growth rates does not mean the end of growth, right? It does not mean late cycle. And we've had this discussion already several times, you and I, but it's important to keep reminding people. So peak growth in terms of year-over-year change, first quarter for Asia with China, second quarter for the US, third quarter most likely for Europe, okay? But then we are moving into a more traditional growth cycle, I think, not late cycle. It's not as if we're going from peak growth to late cycle. We're going from peak growth to a more moderate, more traditional growth path, which is still going to be above trend growth. So we have had a Delta lull, certainly in the US. Q3 is going to be weak, and all the banks have marked down their forecast for Q3. Most have marked up their Q4. Several have marked up their 2022 because you're just pushing out the growth that's going to come from the inventory restocking, right? Which inventories are low across the board, whether you want to talk about, semi chips or autos or things you buy off the shelf in the supermarket, almost anything you want to mention, inventories are low. And so that's going to actually, what we've done is we've kind of pushed growth out. The growth didn't disappear because those inventories are going to be rebuilt. It just got pushed out. So now we have a situation where we're going to have global growth for 2021 somewhere around 6%. We're going to have global growth for 2022 somewhere around 4.5% to 5%. Both of those well above trend, right? So if you look at forecast growth for Europe for next year, it's at 4.5% growth. That's fantastic growth for Europe.
Yeah, for Europe.
And in the US, growth is going to be somewhere around 4 to 4.5% as well. So that's, again, well above trend. The developed country growth since the financial crisis has averaged about 2%. So yes, we're going to decelerate from 6 to 4, but that 4 or 5% growth is double what it's been for the last decade. And this is where I think folks are getting lost a little bit in the translation and having a hard time understanding that. But here's the real point, right, for investors: earnings growth. And I noted in my reading of the JP Morgan work that they just increased again their earnings expectations for next year. So they are now calling for $240 per share of earnings for the S&P next year. If you put today's close on that, you're at about 18 times next year's earnings. Not really very demanding multiple. And Europe's earnings are going to be great. I referenced a couple of weeks ago, Bank of America's one-year forward earnings indicator was talking about 30% global EPS growth over the coming year. And in that environment, I think stocks, notwithstanding a day like today where you get whacked and people want to stay away and they're really unsure, and you go down 1.5% to 2%, you have massive selling. Notwithstanding that, I don't think stocks are set up to have a big decline if those earning numbers are going to have any shot at getting at coming to fruition. And again, I don't think an Evergrande situation derails that growth story. That's the important point here. We did add 2 emerging markets several weeks ago in our model portfolio. And the part of the rationale for that was this idea of Delta fading, Asia reopening, and the move towards a synchronized global expansion. Because while we've had peak growth, now the upside comes from all 3 regions. Remember our tripolar world focus, right? Europe, Asia, the Americas, the tripolar. All 3 regions potentially going forward are going to be in a synchronized, meaning together, expansion, which we have not had yet. Because when Asia was really firing coming out first of COVID in Q1, Europe was definitely not. In Q2 and Q3, Europe and the US were firing pretty well in terms of the economy, but Asia was not. The Asian lockdown story, which we've talked about over the last couple of weeks, Asia, broadly speaking, was locked down as tight in August as it was back in the spring of 2020. So now, finally, we believe we're getting to that point of synchronized global expansion. And that is going to drive the opportunity set in emerging markets, which have really been the big underperformers year to date, right? I'm sure after today, I haven't looked, but I would imagine after today, the broad EM equity indices are probably flat to down for the year.
Yes.
Versus ACWI up probably somewhere around 16%. So EM's been a big underperformer. China's been a big part of that underperformer, but as we know, Latin America hasn't done well, and Europe really hasn't done all that great either. So I think we're set up, if that comes to pass, if the tactical positioning, Delta fade, Asian reopening, better data in the US, if that comes to pass and then rolls into a synchronized global expansion, then emerging market equity should do pretty well. And that's the bet that we made several weeks ago. It doesn't look great today, we'll be honest, down probably pretty much on every one of those positions. But, you know, we're not doing it for today. We're looking the next 3 to 6 months. And there, I think there's a reasonably good shot that that Asia reopens and starts to do well. China, as I pointed out, China relative to the US is as cheap today as it was in 2005. The last time it was so cheap on a forward earnings basis. Okay, so we've discounted a lot with China right now as we speak, right here today. And they wrote a report on the potential for a CapEx boom in the United States. And what really caught my eye was they said the conditions were just about perfect. So when I hear somebody write, who I respect, and whose work I've followed for a long time, it's one of the benefits of having 30 plus years of being in the business. I know who I want to read and who I want to pay attention to in times like this. With Evergrande, I was able to reach out to people who are in China, who I've talked to for years, or in the case of Ian's work at Pantheon, someone I've read for years and years. When he says conditions are just about perfect, he's not, you know, a guy given to, you know, hyperbole. So I want to pay attention. And what he said was that, look, in the US, there's been a lack of capital expenditure by both public and private over the last decade since the financial crisis. At the same time, companies are cash rich. Borrowing costs are super low, and labor is tight. So these are the 3 or 4 conditions that lead him to say that things are just about perfectly set up for a CapEx boom. And he gave us the analog of the second half of the 1990s in the US, where you had productivity surge growing about 3% per annum. At the same time, wages were going up at 5% per annum. But because of that productivity surge, unit labor costs, which is what feeds into inflation, were only going up 2%.
2%, yeah.
And so that's really the golden goal, right? If you can have productivity growing that allows for higher than usual wage growth, so people feel like they have money, they spend money, the economy grows, consumption grows, and you do it without inflation, that means it's sustainable, that you don't need the Fed to come in and slam on the brakes and raise rates and end the story, which is how the story usually ends. Yeah. And so, you know, so I thought that was really interesting. Very well with my view that there is a reasonably good chance that we can shift the developed market economies onto a higher growth path. And that's going to come about through 3 main factors. And I talk about this a little bit in the Musings. The first is the pro-cyclical spending of the Biden administration, or in Europe of the next gen plans that are being, you know, spending that's coming right now as we speak, or in Japan as they look to add a new stimulus package with the incoming new government. So pro-cyclical spending, a CapEx boom, which we just went through, conditions just about perfect for a CapEx boom. Certainly, you think about a new government in Germany, there's going to be a lot of talk about digitalization, a lot of talk about improving the electric grid in Germany, a lot of talk about electric vehicles. Same in Japan, digitalization, critical in Japan. Same in China. So this is one of the things when you read about, like you look at at graphs showing that China fixed asset investing is going down, or credit stimulus is going down, and so commodities typically go down. That's because for the last decade, the only people really spending big money were the Chinese. The point here is that going forward, all countries are going to be spending money because of climate, the need to get to net zero, or peak carbon rather, by 2030. So we're actually in a better place. We're not going to be dependent on China spending money unwisely to keep their economy and the global economy afloat. No, we're talking about a CapEx boom spread across the tripolar world in each region, driven by the need to address climate change and supported by a productivity surge that itself is being generated by first COVID and now climate in terms of adoption of technology. So you have pro-cyclical spending, public-private sector CapEx boom driven by climate, and accelerated adoption of technology driving productivity, all of which suggest that you can have developed economy growth better than expected, a new above-trend growth path. Yeah, well, the period 95, I mean, it's funny. I went back and asked some of the team here to look at the performance of ACWI from 95 to 2000 and then 95 to 99, because they're so different, right? When you include 95 through 2000, you encompass the tech bust. Yeah. And therefore, returns are still pretty good. I think ACWI was like maybe 12 or 13% per annum over that period, which is quite good. If you go from the beginning of 95 to the end of 99, ACWI is up 19% per annum, which is really good. And so, yeah, those were the days. Yeah, well, right. And those were the days of CapEx boom, higher productivity, lower inflation, so you could have a growth cycle that really unfolds and isn't truncated by central bank intervention. And that's why this paper made such an impact on me, that I said I want to write specifically about this CapEx boom, because those are the things that can allow us to have above trend growth, which means above trend earnings growth, which means continued good equity returns. And by the way, this movement to above trend growth is what allows the central banks to get off the zero bound without busting the equity market, right? Because if we have a period of above trend growth with moderate inflation, then the Fed can gradually raise rates in 2020, and here we're talking 2023, 2024, 2025, gradually raise rates and give themselves some room to maneuver and get off the zero bound, which we should all want, right? We don't, it's not good for the central banks to be dealing with zero interest rates, negative rates in Europe, not having any room to maneuver. We want to see stronger growth. We want to see moderate inflation. We want to see over the next 3 years the Fed raising rates to 3% or something like that. Or not really 3%, but let's say the 10-year getting to like 3% and giving a cushion. And I think that only happens if we get this above trend growth, which comes from CapEx boom, which is going to be driven by the need to adjust for climate change. And again, that climate reality of every country in the world focused on meeting peak carbon by 2030, and that timeline, 2030, it forces the mind, it forces the action. And so this is not stuff that's going to be put off. It's going to happen. It's just a question of how it happens. And this gets back to the climate populism, right? And how quickly we move, and then how governments react. And that's why I say one clear takeaway is that fiscal discipline in Europe, a la the way it's been since 2010 to let's call it 2019, pre-COVID, is gone. Is gone. And that's an important thing to keep in mind when you're an equity investor, because it means that you're going to see a government that's going to be more flexible because we're going to go through some very big changes. And for investors to understand the impact of climate, the impact of climate change, what that means for CapEx, what that means for opportunities across different industries is absolutely critical, I think, to being a successful investor over these next 5 to 10 years. Yes. Yeah, I look at EFA now as I did with the US for the last year or so, right? I called it the twin engine market, growth and value, right? When rates went up, cyclicals and value did well. When rates went down, growth did well. Now in EFA, you have Europe having done really well for most of the year. Now, by the way, back to levels 2 months ago, Europe has pulled back all the way back to July levels, even though, as we talked about, earnings, valuation relative to the US, one standard deviation cheap. Europe has pulled back, so looks good again. And Japan has finally taken the baton. So there in EFA, you have the twin engine, Europe and Japan, both driving forward. I think Japan looks really good. This environment here probably allows it to work off a little bit of an overbought situation. I mean, it did go up 10 or 15% in the matter of a month or so. So healthy pullback there, but you have new government coming, a new LDP candidate. LDP will likely win the following election. Stimulus package to come, lockdowns to go away, cyclical exposure to an Asian reopening, activism, cheap valuation, underowned. Foreigners have been net sellers of Japan equity year to date. So yeah, all those things continue to be in play. As I mentioned earlier, we did add to EM, both in Asia, ex-Japan, and in Europe via Russia. So we think that's interesting. We continue to own the cyclical and value segments within the US. So we have not made any changes since we updated our model portfolios 2 weeks ago. So we continue to be overweight equities, underweight fixed income. Continue to think rates are going higher in the US and in Europe, particularly government rates, that is. We still feel okay with credit, particularly in the United States, high yield credit. Been no signs of contagion there, by the way, in terms of thinking about possible contagion across the credit space relative to Evergrande or other things. And very constructive on commodities. Commodities have arguably just broken out of a multi-year downswing relative to stocks, I believe on a 10-year rolling basis. The first positive reading for commodities in about 7 or 8 years. So that's compelling to us. And as we talked about, there have been very big pullbacks. And if we're right about a Delta fade, if we're right about an Asian reopening, if we're right about a synchronized global expansion, we will be right about commodities. And if we're not, we'll be wrong. So it has to, yeah. But I mean, I look at things like the mining stocks. PIC is an ETF that we are invested in. I mean, it's been bludgeoned the last couple of days, really sold off aggressively here. If you look at some of the energy space, XLE and AMLP, AMLP to me seems like a no-brainer. I keep wondering, what am I missing? 7% yield, dividend coverage of 2 times, valuation very cheap, and yet it's just sits there or goes down as it did today. So to me, a 7% yielding energy pipeline midstream play in the United States, I think is very, very compelling. So I think there's opportunities throughout the commodity space. And then thematically, we remain very focused on climate. Carbon, KRBN, was up today.
Amazing was up today. I just saw,
yeah, and that shows you that A, people don't want to sell it, and B, people are looking for things to buy in a sell-off. And so KRBN, we continue to like. It's the single biggest commodity. Well, it's the single biggest position in our TPW20, our thematic model portfolio. And climate remains the single biggest segment of that TPW20. It's about 28%, 29% of that model. is purely climate focused, whether it's carbon or uranium or electric vehicles, etc. Many different ways to participate. So we remain constructive on that thematic space as well.